Dirk Sahlmer, welcome to the show.
Yeah, thanks for inviting me. Glad to be here.
Let's kick things off with something really spicy. Do founders ever regret selling their business?
I would say yes. I mean, it depends on how the deals are structured, but I heard some terrible stories about founders messing up the deal structure. There's a lot that you can do wrong here. So concrete examples. There was a business we were talking to. They ended up selling to a strategic. Strategic basically pivoted, so changed their strategy and sunsetted to the business, took the best developers for their own core product, and basically the business is now more or less dead. I have a second interesting story where we're also in, I would say, advanced conversations with the founder, already agreed on rough terms, etc. And then ultimately also ended up selling to a strategic because they came in on short notice with a much better offer. And they offered a high stock swap component. So basically they got a small cash component, but the majority of the deal consisted of stock of the acquirer. And in the meantime, this acquirer raised a down round and they got common stock. So there's now massive liquidation preferences stacked above their proceeds. And so ultimately they spent 10 years building a business and sold it for pennies on the dollar. So this was super sad to see. And our offer would have been better in retrospective, but yeah.
Absolutely. And I think that's actually unfortunately, a lot more common than what most people think about. Everyone thinks that there's, you put a lot of time and effort and blood and sweat and tears into growing a business, and then you get to the end and you sell it. Happy days, you can sit on a beach sipping cocktails for the rest of your days. But unless you get the exit right, you can end up wasting all of that time and all of that effort unless you do it the right way and you get the right offer and you structure it the right way. And that's what I wanted to talk to you about today, Dirk. So I know you got a lot of experience in that and a lot of war stories as well. So before we continue with the rest of this, why don't you jump in and just tell everyone watching and listening to this, who you are and what you do?
Yeah, so I keep my introduction short. I'm Dirk, I'm head of Origination of SaaS Group. Joined the company as one of the first employees. Got very lucky, I did something completely different before. Ran into the SaaS Group founder, found an interesting opportunity and luckily got hired. And since then I've been responsible for deal origination or deal sourcing for SaaS Group. So as you can imagine, I'm talking to hundreds of founders every year about exits, trying to get in touch with them, follow their journey, and then speak more concretely once an exit becomes more relevant. And a few words about SaaS Group. So we are a serial acquirer of small SaaS businesses. The company has been founded by 3 German tech entrepreneurs. They had previous exits with software companies and had the idea of building a platform of independently run SaaS companies and have some shared services where we can really add value because there's so many small SaaS companies that hit a ceiling at like 2, 3, sometimes 5, 6 million ARR and are looking for ways to get to the next level. And we acquire those businesses, we keep everything as is, so protect the legacy the founders have built and have some central services, big marketing team, big internal product team, some standard things like finance, accounting, HR, recruiting, and so on. And a lot of those businesses just run with a team of 10, 15 people, sometimes maybe a few more, but they are super lean and they do not necessarily require an in-house recruiter, an in-house accountant, finance people, and so on. And with our approach, they can stay quite lean, super productive, and super product focused, and we can help with all the rest. And the goal is really to build out that platform and acquire more and more companies over time.
And what sort of businesses do you like to acquire the most? Like, is there anything that you look for in terms of particular verticals or geographic markets or anything like that?
Yeah, I would say unlike many private equity players that are more leaning towards vertical software and very sticky products, we decided to go a different way and focus on horizontal businesses. So if you look at our portfolio right now, you see MarTech businesses, you see productivity tools. So usually products that can be used by multiple segments. And we also focus on low-touch sales model, or you would also say product-led growth companies versus sales-led, because we are experts with that inbound motion, with a big marketing team in-house and so on. that can help with SEA, SEO, PPC and all that stuff. So we're really focusing on horizontal PLG companies.
Fantastic. And that's saas.group is the website URL, correct?
Yes, correct.
Well, there you go. So if anyone watching or listening to this is interested in or thinking about an exit in the next couple of years, maybe drop Dirk a message and have a conversation there. But Dirk, let's jump in. I wanted to ask you a little bit more about some basic stuff first. So how do you actually decide how much a SaaS business is worth? Is it a multiple of revenue? Is it a multiple of profit? Do you take churn into consideration? Like what goes into valuing a SaaS business?
Yeah, it's actually a lot of factors. So it's sometimes interesting if founders drop me a message, say, here's our revenue, this is our growth. Can you tell me what multiple I can expect? That's usually not how it works. And it also varies from buyer to buyer because their interests are so different. I would say they are, on the one hand, quantitative factors. So growth is still one of the top valuation drivers. But then you also have other factors like quality of revenue. So how is your gross dollar retention, your net dollar retention? How does your rule of 40 setup look like? And how efficient is your business? Also your customer acquisition, LTV to CAC ratio, CAC payback, so the typical SaaS KPIs. But then there's also a lot of more qualitative factors. So what's your moat? How strong is your IP? Do you have any technical depth? Is it all like up to date? How fast is your market growing, the market you're in? Do you have any, for example, client concentration, which puts the acquirer at risk? So a lot of more qualitative factors that can ultimately decide what you're getting, and then more quantitative factor. And we are a serial acquirer. We run an evergreen model. So for us, financial health is very important. And you can tell us how strong your moat is, but if it's not reflected in your KPIs, then we cannot price it in necessarily. While if Microsoft buys a company, that's a multi-billion company, they don't care about your revenue growth. They would rather buy you because you have access to clients or you build like a strong IP that they want to own. So it's very different, but for us in particular, it's more about financial health and KPIs.
Hey, it's Ryan here. I'm glad you're enjoying the video. Listen, if you want to meet me or some of the people that I interview, you should really join the Startup Source SaaS founder community. It's a private Slack group for SaaS founders based outside of Silicon Valley who are past the idea stage and want to focus on growth. About 30% of our members are doing over $1 million a year in revenue, so it's a pretty high caliber group. You'll get access to regular mastermind calls and workshops, and every week we share exclusive marketing tactics and resources that you can use to grow your business faster. So, if you want to give yourself an unfair advantage and learn from other SaaS founders who are 1 or 2 steps ahead of you, head over to startupsource.com and sign up. I think there's a link in the description down below as well. Anyway, I'll see you in there. I know in this space that there is a lot of jargon, there's a lot of more technical terminology. You mentioned the rule of 40 there. I'm just wondering if you could kind of unpack some of that, maybe for people that are, more used to building companies than they are to buying and selling them.
Yeah, so in easy words, we want to see that you can acquire customers efficiently and profitably after all. And we want to see that you can retain those customers. So simple example, I've seen companies that grow 10% month over month, but they're also losing a lot of customers over time and sometimes quite quickly because a lot of customers are curious, trying out the product, especially now with AI SaaS tools, but they also quickly churn if it doesn't provide the value. And so customer acquisition is great, customer retention is even more important. That's why, for example, many private equity players are focusing on vertical solutions because they tend to be more sticky and tend to have greater retention metrics. So yeah, that's what ultimately drives the valuation. So big plus is if you can do both, acquire customers and retain them and also upsell them, so increase accounts over time, meaning that famous net dollar retention of over 100%. So ultimately the revenue acquired this month, for example, becomes more of the same customer group over time. So your cohorts are growing and you could basically stop customer acquisition and still continue to grow. Yeah, and then with the rule of 40, also became more popular recently is growth rate and profit margin combined. So if you're growing 20% year over year, and you have a 20% EBITDA margin, that would equal to an exact rule of 40 setup. And it's actually an efficiency metric and a financial health metric. So ideally, you have a great balance, so your company grows and it's profitable. It's especially important for smaller SaaS companies because buyers want to see cash flows.
And probably the easiest thing to do is just Google that and then plug it into a spreadsheet, plug some numbers in and see how you stack up. It's interesting that you mentioned the expansion revenue. And I interviewed Tim Cool from Smart Church Solutions. I'll stick a link up there somewhere. So he got to negative churn recently, which is a beautiful, wonderful place to be. I don't know if most SaaS businesses ever get there, but it's really clever the way that he structured his pricing so that even if he doesn't acquire any customers in a given month, his revenue is still growing because so many of them end up upgrading to a higher pricing tier later on, just because of the way that he structured his pricing. So I think there's a lot of value in being clever about the way that you approach pricing that maybe a lot of founders don't think about necessarily at the beginning.
But admittedly, to add to that, it also depends very much on your product, whether you can achieve it, right? So we were talking about our target group with SaaS Group. So we are targeting horizontal PLG products. Usually those companies have a large client base in the SMB sector, and these businesses tend to have higher churn, so they rarely achieve net dollar retention of 100% or net negative churn. So it's super hard to get there. I would say it would already be top notch if they are 90-95% plus, and we rarely see 100 plus. But as you said, there's an opportunity to work actively with customer success to improve it, or also with pricing and packaging. We also see in the market currently a switch towards more usage-based, outcome-based pricing. So this is also an opportunity for many to expand their existing accounts and create upselling opportunities that ultimately lead to better retention metrics.
And do you have any benchmarks in terms of churn rate, or does it vary wildly from sector to sector and stage of growth that you're at and everything else? Or, could you say, anything, if your churn rate is above 3%, then you've got problems. Or your churn rate's above 5%, then you've got problems. Like what's a good churn rate look like for you?
I would say in the space we are in, everything above 5% monthly revenue churn is somewhat concerning, and we would take a closer look because it's hard to offset it with upselling and account expansion. I would say 3% is more or less the average we see. Ideally, you have below 3%, so more like 1%, 2% monthly revenue churn. That's okay. Then we would check the box and say, okay, this is a relevant opportunity. If you're above 5, then usually your retention metrics are too bad for us to come up with an offer.
Okay, so that's something concrete that founders can think about now. If you're planning on exiting in the next couple of years, you really want to get your churn under control. I mean, you want to do that anyway, but it gives you some numbers to aim for.
Yeah.
You also mentioned the CAC to LTV ratio. So just can you unpack what you mean by that?
Yeah, so LTV means the lifetime value. I mean, it's just an estimate because sometimes you get lifetime values of like 100,000 and a customer lifetime of 25 years, which is of course unrealistic. Nobody knows if your company even exists by then, but it's just like a metric you can observe and you can check whether you are able to improve it. So customers tend to stick longer with your product, and also if your customer acquisition is actually profitable. So CAC means customer acquisition cost, LTV means customer lifetime value, and ideally the CAC is only a fraction of what you can earn from a customer over time. So I don't know who coined it, but I think David Skok or someone from the SaaS base said like something around 3 is considered healthy. I would say for our PLG SaaS companies, we would like to see something bigger, like a better ratio than 1 to 3. I would say this is more for enterprise SaaS companies or VC funded SaaS companies that spend a lot on marketing. I would say for our businesses, it's usually more like, I don't know, above 5, sometimes even above 10.
So just to clarify that, so what you'd ideally want is the lifetime value of a customer to be 5 to 10 times what it costs you to acquire them in the first place.
Yes.
Is that, yeah, okay, cool. So good ratio to keep in mind for anyone watching and listening to this. Awesome. Dirk, let's change tack a little bit. I wanted to talk to you a bit about timelines, because I know this is something that a lot of founders underestimate. So in your experience, how long does it take from initial conversation or when founders start thinking about an exit through to actually signing, and then what happens, until they can actually leave the company as well, because there's the golden handcuffs quite often and all that stuff as well. So can you kind of talk us through that timeline and what that looks like from the founder's perspective?
Yeah, quite interesting observation on this topic, because I recently analyzed how long it took SaaS Group portfolio companies from first contact to closing, and I did a post about it saying that I think the average was a bit over 600 days, so almost 2 years. And some people sent me DMs saying, but on your website it says 6 or 8 weeks from beginning to closing. But this is like the actual process when it becomes concrete. But there's a long period of relationship building, catching up, following a company's journey. And I keep repeating myself here, and I say it over and over again. If you want to increase your chances of finding the right exit partner and getting the deal you deserve, actually this relationship building starts today. So, I mean, of course, if you haven't found product market fit and you're still busy with product building, then maybe not that relevant for you and not a top priority. But if you're at a certain stage, let's say 1 million ARR or whatever, you should start figuring out like, what are potential exit partners? What is their rationale? Why are they buying companies? How do I get in contact with the right people there and just put myself on the radar? And this is especially relevant for strategic exits. So, I mean, taking the Microsoft example again, Microsoft doesn't care about your small independent SaaS businesses somewhere in Germany. And unless you do some efforts to put yourself on their radar, you will never get a chance to sell to them. And so, yeah, I would encourage every founder to work on those relationships early on. I also get angry messages to my outreach sometimes saying like, I'm never going to sell, please never contact me again, unsubscribe and whatnot. I mean, it's totally fine. Like every CEO gets bombarded with outreach and cold calls and all that stuff. But I would at least build an internal Rolodex of contacts. So if it becomes relevant, you can already like reach out to 20 relevant companies and see if they are still interested. And so, yeah, for us, it's a bit like enterprise sales. Sometimes it closes within a couple of months from first contact to closing, but very often it's 2-3 years. So as said, I joined 5 years ago. There are some opportunities that now slowly become relevant. So it took 4 or 5 years for them to actually think about an exit more concretely and approach me to discuss it. Yeah, and because you also asked about the process post-acquisition. So we at SaaS Group are quite flexible and we can offer whatever the founders prefer. And we had founders leaving after 6 months, 3 months. We also have founders that have been with us for over 2 years. So it really depends on what you want. We don't necessarily give you golden handcuffs unless you want them and you want that future upside. But it's recommended that I would say founders stay at least for 6 months, 12 months to ensure a proper handover, a smooth transition. Also in case we would need to hire a replacement, so that process kicks off and they would stay involved and also maybe give the approval for the successor. So yeah, ideally we have 6 to 12 months, rather 12 months. But again, we also had founders that stayed for over 2 years. And it depends a lot on the buyer type, what they could offer and how flexible they are. I mean, some might give you a super attractive offer, but give you golden handcuffs for 2-3 years. And if you leave, you won't get an earnout or anything and miss out on a lot of deal value. So another tip for founders is to really think about their preferences and bring it up in negotiations to really make sure it's reflected in the offer that a potential acquirer will give you.
I think that's one of the common misconceptions that a lot of first-time founders have, which is they sell their business and then they're just, cool, great, get a bunch of money, go off and live their life and go on and do the next thing. But in reality, there is that transition period where they do need to be around to ensure a smooth transition over to the new owner, because there's a lot of domain expertise, there's a lot of insider knowledge that they've got in their head that you just can't easily replace overnight. There is a learning period as well that goes with that.
And I mean, we talked about the founders regretting selling their business. I mean, we see this especially with, I would call them failed VC cases. So founders that went down the VC track, but then couldn't sustain that hyper growth model and are now in the bad bucket of the VCs and can't expect a high exit. Then very often founders would walk home with zero because of liquidation preferences, because investors usually first get their money back before founders or teammates get anything. And then you're somewhat forced to accept golden handcuffs or an earnout and stick around for a while, because otherwise you would not get anything for building your company for a couple of years. So on the one hand, it's your personal preferences, but sometimes it's also external factors that might force you in either direction.
I think the key lesson there is, even if you're not thinking about selling your business right now or anytime soon, still doesn't hurt to start cultivating some of those relationships, because it is going to take a while
Absolutely.
to be able to actually sell your business. And you see this all the time too. You think, oh no, I'm never going to sell my business, and then a year later, you have a kid. And suddenly that exit looks a lot more attractive than it did 12 months ago, or something changes in your life, or even you just get burnt out. I don't know if you see this quite a bit, but some of the founders that I'm friends with or that I deal with in the startup source community, if you've been working on the same thing for a while, for working 10, 12-hour days, year in, year out for 2 or 3 years, after a while you're like, I think I've taken this as far as I can, and it's maybe I didn't hit all the goals, and maybe it's not growing as fast as I'd like, but I'm just kind of I don't love it anymore. I'm getting a bit burnt out. And in that scenario, what do? Do you just shut the business down and walk away and lose years of hard work, or do you look for an exit then? So I don't know if you see that a lot, but in terms of the reasons for selling a business, is it always a planned exit, or do you see founder burnout, or do you see maybe the co-founders have a disagreement and they just can't resolve it, and so they decide that the only thing to do is to sell the business? What are the common reasons for selling that you see beyond just someone gave us a good offer and that seemed great, so we said yes?
Yeah, I would say a common picture I see is that founders value the freedom they are getting and the certainty of that liquidity are getting as more valuable than keeping the business. And this can have multiple reasons. As you said, some have got children, so priorities have shifted. Some are getting burned out. I also had a few funny things where a founder was just dreaming about buying a Porsche, and so he wanted to sell, and the first thing he did was buying a Porsche. So very interesting things. Sometimes that also makes my job interesting, because there's so many stories, so many goals, so many dreams. And I also feel sometimes like being a psychologist and just have a session. And I even had founders crying because they were burned out and they were chasing a certain carrot because they thought, I would not quit before getting to 3 million ARR, or I would not quit before entering whatever Benelux market. So they set high goals and struggled to achieve them, but it kept them going and going and going. And many also only look at external factors. So they think, now the market is not right for me to sell the business, I would lose out, multiples are not in my favor, blah, blah, blah. So I think it's important, yes, you can look at your current growth rate, whether it makes sense, and current multiples and whatnot. So of course you can also take external factors into account, but you should also listen to your gut feeling and maybe reflect and see if this is still something you're passionate about and you think you can achieve your desired goals and you're still happy in your current situation. I think very often founders I talk to should have sold years ago, or at least some time ago, and just like kept in that hamster wheel because they thought they would lose out on something.
What are your thoughts on partial exits? I've seen this happen a little bit recently where usually from private equity or something like that, where they might buy 50% of a business, 60% of a business, 75% of a business, but the founders still have a pretty significant stake. And I think the idea is that they're still motivated to continue growing the company and eventually flip it and get a share of the upside later on as well. Is that something that you've seen? Is that something that you guys do? What are your thoughts on partial exits?
Yeah, so it's not something we do. So we prefer full acquisitions to get into control. Also because we now own a big portfolio, and it just adds a lot of complexity by doing majority deals or partial deals, because you need to agree on what's going to happen in the future, because of course in the long run we want to get to 100, and since we're not selling the businesses we acquired and have that evergreen model, it will be just hard to find like the right deal structure. But I've seen it happening. I would say you should be pretty clear about the consequences, because that also means it's just a liquidity event for you and not the end game. So most buyers will require you to stay on board and stay in the driver's seat for the next couple of years, not just a couple of months, but more like 2-3 years, maybe even longer. And I would also take a very close look at the deal structures, what the acquirer can do if things are not going as expected. Because, I mean, private equity is a hard business. They have like a holding period of 5, 7, sometimes 10 years to generate a return. And if they're not thinking you're the right one for that job, or if you're not delivering on their expectations, they will quite quickly get rid of you and hire someone else. And then your upside is gone. Depending on whether you're a good leaver or a bad leaver, you may get something. But it's like, on the one hand, you should be clear about the fact that you will stick with the business for a longer time, and it's not a real exit, it's more like a liquidity event. And the second point is you need to be sure that you can manage that next growth phase of the business and you're the right one for that position.
And I think a lot of founders struggle with the fact that they're not the boss anymore. They've got someone else controlling the money, got someone else calling the shots, and it sort of feels like they've got all the responsibility of being a founder, but without the actual the power that they're used to having in terms of being able to be the master of their own destiny. So I think it's an interesting option, but I understand why maybe you guys prefer not to do it that way, and probably a lot of founders prefer not to do it that way as well. But I have seen a little bit more of that recently.